This is Bob Brooks, host of the Prudent Money Radio Show, heard daily on Bible School Radio 91.3 KDKR, Decatur, Dallas, Fort Worth, and on 91.3 KYJC Commerce.
Portions of KDKR programming do not necessarily reflect the views of this station, its management, or staff.
Prudent Money with Bob Brooks is sponsored by the Prudent Money Foundation on 91.3.
Well, when will the bond market be a good investment again? Today we're going to take a look. Stay tuned for Prudent Money. Good afternoon. This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thanks so much for joining me today. You know I do appreciate it. Listen, if you got a question for me, I want to invite you to go to the website and go to the question and answer section, and send an email. And if that doesn't take care of it, if it's a little bit more of a complex situation, you can always look for the calendar that's on the page and book a time that on that calendar that we can talk over the phone and get your situation worked out. So there's a couple of resources for you. They're all at the website, www.prudentmoney.com. So the question is, when will bonds be a good investment again? And I also want to make sure that people understand what happened to make bonds kind of a miserable investment. And this is one of the things that I had been concerned about for a long time, is that you just knew that at some point bonds were going to run into a problem because they've been good for so long. You know, it's kind of one of those boring investments that year in, year out produced a good, solid, kind of lower return, but it worked and it kept people with their achieving their goals and living their retirement. And even pre-retirement, there's a lot of people that would invest in bonds. And while investing in bonds, the assumption is that, well, this never loses money. Bonds are as safe as they can be, but bonds have a risk to them. So to see this whole story, you have to go back to the Federal Reserve Board. And I explained some of this at the webinar today. Had a great turnout and talked a lot about risk and what you should do with your 401k plan. And there's still another webinar to go for this week. It's on Thursday at noon. So if you haven't signed up or you signed up today, you could make it. Go sign up for the one on Thursday. And I think that you'll be glad that you invested some time into it. I know it's not always easy to invest in time into something like that around that time, but it's definitely, I think it's worthwhile. And you can do that at prudentmoney.com. But let's start with the Federal Reserve Board. The Federal Reserve Board is the main bank of the world. And I say that, I exaggerate just a little bit, but they have so much power. Think about the power that the institution that can control the money, how powerful that institution is. And that's what the Federal Reserve Board does. They control the money. They maintain inflation, and they maintain the economy at certain levels and certain rates, and inflation started getting a little bit out of control, and then started going up. You remember that? And so the Federal Reserve Board stepped in and started raising interest rates. And what happened? Now, you know, any economics 101, any textbook would tell you that you raise interest rates, and the inflation rate would start to fall. But that's not what happened. The inflation rate fell a little bit, but for the most part, it's just kind of remained constant and stagnant. And one of the things we've talked about quite a bit on the program is that is a real problem. And it's one of those things where you can only deal with a flood situation for so long. At some point, the flood's going to win. And I think it's the same thing. The inflation has gotten to a point. You know, I heard that, and it's really a contrast, but I heard that I was talking to a friend of mine about high-end steakhouses. I don't know how that came up. But anyway, we were talking about it, and they were talking about how the high-end steak houses were having problems with bringing customers in, and they were having problems with getting people to come and dine in their restaurants. And you're even seeing that at McDonald's, far from the high-end steakhouse by a lot. But you know, you could always depend upon McDonald's if you have a family to eat, to feed, provide dinner and at a reasonable cost. And it's even McDonald's is having issues, which just points to the consumer is having issues. But yet, this is something that the media is not really writing about or talking about. So the Federal Reserve Board has raised interest rates, and inflation has just kind of stood still. So the question is, does the Federal Reserve Board, according to the market, they want them to cut interest rates? But all the time that these rates are going up and these rates are going down in the bond markets, so are bond prices. And this is what has happened is that, remember, there's an inverse relationship between bond prices and bond and between interest rates and bond prices. So as interest rates go up, bond prices go down. As interest rates go down, bond prices go up. And we saw interest rates go down for such a long period of time, and bonds were just consistent performers. And that doesn't last forever. It catches up with you, and it caught up with the current bond market. So it's something that I don't think that people were necessarily ready for. Those that invested in bonds and bond funds and that kind of thing. And so the bond market has just struggled because of higher interest rates. So if rates are cut, does that mean bond prices will rise? Well, I would like to think so, but sometimes the obvious that happens isn't what really happens. And it may be that we're going to have to see interest rates cut quite a bit to get a reaction by the bond market. But that is what has happened to bonds. And interestingly enough, we've talked about high yield savings accounts, and I feel pretty confident to say that they should, if the Federal Reserve Board should start cutting rates, that those high yield savings accounts will start to fall as far as the interest rate that they're paying customers. Now, when I say high yield savings account, those are the accounts that are earning like roughly 5%, a little bit over 5%. And you find them at the Fidelities and the Vanguards and the Charles Schwabs of the world. Don't really find them at banks. And they are returning very good returns. That is tied, though, directly to what the Fed does. So if the Fed starts to lower rates, which I still, maybe they'll lower them by one time, but I still even think that's a mistake, because why they raise them to begin with? To fight inflation, and inflation is not. We still have a long ways to go, apparently. So it'll be interesting to see, but I do think, though, that the high yield savings account will go down in as far as return goes. And, the truth is they could still be a good place to save money, because you're probably they're not going to go down quickly by any stretch, either with the Federal Reserve Board. So we'll see what happens, but that's been the problem with bonds, is that bond prices go down when interest rates go up. It's an inverse relationship that stands true at most all the time. This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thank you so much for joining me today. You know I do appreciate it. If you do have a question for me, please go to the website at prudentmoney.com. Send it in, and we'll get that taken care of for you. That's off the website, www.prudentmoney.com. I get the question quite a bit about what's the difference between bond funds and just plain single-issue bonds. Well, with a single-issue bond, you invest money into the bond pays an interest rate or a coupon rate to you over the period of time that you own the bond, and then when the bond is due, you give the lender, really it's a debt. The lender gives back your principal, and the bond is complete. Now, you don't care. There's two things that don't really bother you about the bond price. If it goes up and down, it doesn't matter to you, because you're supposed to get the amount of money that you put into the bond at the end of the term. And as long as that doesn't default, you're in good shape. As long as the company doesn't go down or anything like that, or the bond default, you're in really good shape. So you don't care what the price does if it fluctuates. You've got that safety net attached that makes they get your principal back. So that's the whole idea. The whole idea is to put the principal into the bond, get the interest and the coupon rates, and then get the principal back. Hey, this is Bob Brooks. More to come. We're up against a break. Stick around. I'll be right back. This is Bob Brooks, host of the Prudent Money Radio Show. I think that I am like most people when it comes down to webinars. Find a webinar that I know I should sign up to watch. I sign up for it, and then I let another task prevent me from watching it. Don't let that happen this time, and let me tell you why. My goal is for this 30-minute educational mini workshop, as I call it, is to teach one concept. How do I know that it's worthwhile? Well, over 32 years of working with investors, coupled with hosting a daily radio show, allows me to see what investors are doing right with their 401k plan and what they are struggling with. With the threats of risk all around, wouldn't it be nice to know you have a strategy in your back pocket to help you fight off risk with your retirement? The ability to protect your retirement accounts is the missing piece. I want to invite you to a 30-minute webinar that will be held at 11:30 on the 7th of May, and the same webinar at 12 noon on the 9th. Today, I believe that managing risk could be the most important aspect of managing your retirement plan. Come and join me. Register today at www.prudentmoney.com.
In 1 Corinthians, Paul reminds us to run the race of life to win the prize. Join me, Dr. Erwin Lutzer, for Running to Win. Be strengthened to finish your race with confidence.
Weekday mornings at 8 o'clock here on KDKR.
Welcome back. This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thank you so much for joining me today. You know I do appreciate it. If you got a question for me, please go to the website at www.prudentmoney.com. Send a question into the email system. We'll get you taken care of. It's a great way to get information. If that doesn't work, a couple of emails back and forth. If it's a little bit more complex situation, you can always run that through setting up a time on the calendar, and we'll have a phone call and talk a little bit about your situation, make sure that you get taken care of. There's no cost to that. It's all a part of a resource at prudentmoney.com. I was talking about bond funds versus bonds. And what I said right before the break was that the bond, You buy the bond, you give the money to the company. They pay you an interest rate up until the time that the bond is due, and you get your money back. So as long as it hadn't defaulted, nobody went out of business or anything like that, you should get your money back and everything is great. And that happens the majority of the time. Obviously, the higher the risk that you take will be, the higher the bond yield will be. And the lower the risk is the same thing. So at some point, bonds are going to be a great buy again. And using a bond fund is one way to do that. A bond fund is a portfolio of bonds, and what ends up happening, though, is that there's no end date within a bond fund. So a bond fund could go down 10%, and you're going to feel that 10% because that is the value of the bond fund. And then if it rebounds, or how long it takes for it to rebound, you're going to feel that as well. It's just like an investment, like a stock fund, like anything else. It goes up and down. You do not have that safety net like that you do with the bonds, because there's nothing that says that with the bond fund that if you invest $100,000 in this bond fund that you're going to get your $100,000 back. It doesn't work that way. With a bond, you're supposed to get the money back unless something like a default happens. So a little bit different way they both work, but that is how they work, and it's good to know that, because for someone, the problem with a bond is that today you just can't get very good interest rates on them. Now, when those interest rates start to come down and bond prices start to go up, you'll start to see a much better environment. Hopefully, like I said, that's kind of what we all assume, but we'll see for sure once that's what the market does once that happens. But one of the things that I talked about today is just you need to make sure you stay informed, and you can do that by making sure you're on the Prudent Money e-letter list, and that's the way I can keep you informed. And I will talk about when I think bonds are starting to look good. Don't think that that's the case now, or will be for a while, but we'll see. It's going to be an interesting year. One of the things that we talked about today at the webinar is the risk facing the U.S. investor. Now, there's always going to be risk. No question, there's always going to be risk. And but there are risks that you have to pay attention to, I think, a little bit closer than other risks. And so what I typically do every January, and we stopped doing this right at COVID 2020, as I make a long list of the risks that investors face going into the new year. Well, today was the first webinar that I've done, and doing the next one on Thursday, which you can still sign up for. And I went ahead and put my list together, and it's a pretty long list of the risk facing the U.S. investor. Obviously, inflation is a problem. Now, let's just use common sense here for just a second. If ultimately you have to slow the economy down to a point to where it can affect inflation in a positive way by making it go down and eventually making it go away, then we know then that the economy is going to have to go down in order to do that, because interest rates by themselves is not pushing inflation down. So if inflation is ultimately goes away because of higher interest rates, follow my logic here, then why would it make sense to cut interest rates if you're the Federal Reserve Board when inflation is still high? It doesn't make any sense. I think that they are just playing games with the markets, telling the markets what they want to hear, and the market drinking the Kool-Aid. Won't be the first, won't be the last. Always seems like something like that's always going on. But to get rid of inflation, they're going to have to stop messing around and take some big moves, which could end up putting us into a recession. For a long time we talked about all the indicators that were saying the recession was on the way, a recession was on the way. This indicator is right, 90% of the time. And for some odd reason, the recession risk went away. Now, I'm not naive enough to think that the economy is just smoking hot or anything, because I don't believe it is. But what do you get when you get high inflation and you get a recession where things are you have a declining economy? You get what's called stagflation. I know it hurts my head too. So that's definitely something that is worth keeping an eye on. Like I said, I would be surprised if they lowered interest rates anytime in the near future. Politics is a real doozy. I mean, it is a mess. And there hasn't been debates. There hasn't been. Of course, it's a little too early for debates. But it didn't feel like there is a presidential election going on. But here we are, and it'll be interesting to see. And this is assuming that Biden and Trump are going to be going against each other for the office of presidency. I don't think that can be a sure thing with today's political environment and things that could happen. You just don't know. But let's just assume that they are. You can't automatically say that, well, if this person got elected, this would be good for the stock market. If this person got elected, this would be good for the stock market. You take Trump is a little bit more geared towards things like he's already talked about how he would go back after China again. Well, that's not going to be good for our economy. So it'll be interesting. You can say all that you want how you feel about Biden, but Biden really hadn't done anything, so he's pretty market neutral. The market doesn't really react to him because he stays out of it. Whereas Trump is always trying to pump up the market. So it will be interesting to see how all that plays out. But that is a risk leading up from today until November, and then seeing how things work in the rest of going into 2025. It'll be very interesting to see how the markets react. I'll never forget the night that Trump was elected. The Dow Jones Industrial Average was the overnight markets. We were watching. A friend of mine was over at our house, and we were watching. He manages money as well, and the market went down. The Dow Jones Industrial Average was down 800 or 900 points, meaning that it was going to be a real doozy come the next day. Trump won, and the market was falling because Trump won, because he won. But then he did a brilliant thing. He got on air and told the markets everything Wall Street wanted to hear. The market went up, never looked back. So we'll see what happens with politics. It's quite a mess. Quite a mess. The next one we talked about was the dollar crash, and this is when I talked about it today on the webinar. Is that this particular risk is really talked about quite a bit, and I don't put any concern really about this, because, like it or not, the U.S. dollar is the king currency, and controlled by the Federal Reserve Board. And at some point, 35 trillion or 40 trillion or whatever the number is going to be in the future is going to matter, and there's going to be a problem with all that debt. But I do believe that's a very, very something that's way off into the future and not today's issue. Then you got things like war, something you got to consider with what's going on in the Middle East, cyber attacks, which we've been seeing quite a bit of, civil unrest. That's probably makes the list, but nothing that, at least right now, that we need to be focusing on. Terrorist attack is always on the sheet, the list. The debt, the debt's a problem until it's not a problem. That's hard. That remains to be seen. So that's kind of the list, and the things that. Well, actually, not all the list. There's still some more things on, like the banks and the commercial real estate and all that type of thing. But, hey, more tomorrow. We'll talk more about it tomorrow. Make sure that you do go to the website at prudentmoney.com and sign up for the next webinar. This is Bob Brooks. We are all out of time. Until we do meet again next time, keep the faith and have a great rest of the day.
That's all the time we have for today. Questions or comments for Bob, or to find out more great information like what you've just heard, visit www.prudentmoney.com. Be sure to join Bob Brooks again for the next edition of Prudent Money.